Hey everybody, Frank Finance here. Hope you're having a wonderful day. In today's video, we're going to talk about the how and why interest rates affect stock prices. In order to do that, I'm going to talk about the Fed funds rate and how that affects interest rates. We're going to talk about how interest rates affect spending and how spending affects stock prices. Now, the federal funds rate is the rate at which banks borrow from and lend to each other overnight. It's basically the lowest interest rate you can get, and it's only between bank to bank. Now, over the last 20 years, you can see where that interest rate has been, and you can see that it's basically been almost over the last 10 years, it's basically been close to zero for 7 years of that, and is recently starting in 2016, they started increasing the federal funds rate, and during the pandemic, it dropped down almost close to zero. So what does the federal funds rate affect? So it basically affects interest rates downstreams. As we talked about earlier, it is basically the minimum that banks will charge each other. Now, one thing I will note here is that for consumers on mortgage rates, you saw back in 2016 those federal funds rates started to increase, but you saw little to no effect on mortgage rates, only by about 1% or so in terms of it almost going up 2 percentage points. So the whole point here is it's kind of the floor. It is definitely doesn't affect rates one-to-one, but it will affect how companies are able to borrow money for acquisitions, buy land, equipment, projects causing expansion. And on the consumer side, it can affect mortgage rates and credit card rates and other consumer loans, such as like small business or just like a car loan or something like that. Now, the reason why this is important is because it can help affect spending. Now, historically, when interest rates do go up, consumer spending decreases as well as business investment. Now, on the flip side, as interest rates go down, this does help spur consumer spending and also helps business invest more. So how does this affect stocks when interest rates go up? Well, basically, if consumers spend less, it could cause a decrease in revenue or slowing in revenue growth for a company, which will decrease their valuation. Another thing is it will increase the lending costs. So if they have a project or initiative or an acquisition, whatever it may be, the overall return will be lower if all else is equal. So it will also decrease their overall return. And with those two basic factors, a company seeing both of those factors or one will be worth less with all else being equal. So another thing here is on that increase in lending costs, this does affect the weighted average cost of capital, which is factored into discounting companies, discounting free cash flow back when you're doing certain valuation methods. So this overall is just two basic reasons why stocks will go down if interest rates go up substantially. Now, one thing I want to note here is when the federal funds rate increased in 2016 for the first time in like 5 years or something, we did see a slight pause in contraction in the S&P 500. But if you go out a year and the four years following, you did see a massive expansion from that 2016 number, even as the federal funds rate was increasing. So it doesn't always mean that the stock market is going to be, it's not an exact correlation. That's what I'm trying to get to. If you like this type of content, please consider subscribing. I do videos on personal finance, investing, and stock analysis. Also hit that like button. It helps me out a lot with this particular video. Thank you so much for watching. My name is Frank Finance.